Well, good afternoon, everybody. Welcome to our first webinar of the year. Can't believe it's the end of January already. And as you can see there, our title for our webinar today is the roadmap for what investors can expect in 2024. Excuse me. So it's hard to look back to 2023 last year and not feel a little bit punch drunk. I know I was one of those people that was punch drunk. You know, the year started off last year with expectations of a recession in the US and a boom in China, and neither of those things came to pass. Yeah, in South Africa, obviously the South African economy experienced both positive and negative developments. The year started off with much uncertainty, and there was concern about elevated levels of price inflation. Obviously, that was a lot from the supply chain perspective. If you look at the market itself, the JSE All Share Index saw a slight gain for the year, despite foreign investors obviously divesting or selling out of South African shares and bonds over concerns about inflation and central bank policies and political tensions. South Africa's national elections this year are deemed market relevant, but obviously uncertainty, that word will come up quite a lot in the presentation today, uncertainty continues to hamper investor confidence. So reflecting on all of this, many of you must probably are wondering, where should you be investing this year? So guys, welcome to, as I say, this webinar. My name is Sean van den Berg. I'm investment specialist at PSG Wealth. I'll be discussing a bit of a review of last year, as well as also touching on the outlook for 2024, and explore the investment opportunities that may be on offer. Okay. So excuse me, as I said, I do have a bit of flu. Those are my agenda for today. Last year, okay, if we had to reflect over 2023, I think one of the best performers for me was winning the Rugby World Cup. Yeah. But saying that, also we navigated through walls, multiple ones as such. We lived through high interest rates and high inflation economic cycle. So those are, we lived through it. Yeah, we survived. So we've also been feeling the impact of load shedding, both in our homes and in our businesses, and obviously we're also finding ways to navigate through that. But as I mentioned just now, the word uncertainty will come up a lot. Volatility comes with uncertainty. So the market doesn't like the unknown, and is also not particularly fond of high inflation cycles, and that's what we've been experiencing. What we do know, however, is that staying the course with your investment strategy remains key. Okay, so just some, if you had to ask the big institutions where they think the markets will be at the end of the year, where would the S&P 500 be, and where would the bond yields be, and the exchange rates, and you'll see that we've got this is all the big institutions, so the big companies in the States. Got Goldman Sachs saying that the S&P 500, the index will be at 5.1, very similar to Deutsche Bank, but you can see a wide range. So even the big institutions don't know what to expect this year. So it's difficult to anticipate what's going to happen in the markets. So even the big guys can get it wrong. Okay, so I just wanted to bring that in first of all. But also saying that is that the markets, if you look at the long-term trend on the market, this long-term, what they call the long-term secular bull market, is always up. So yes, we got those little stages where we go sideways, and we have these little stages where we pull back, but the long-term cycle is always up, bullish cycle. Okay, so always keep that in mind. So the long-term trend is a bullish story. If you look at what's happened on the world markets, the Dow Jones and the S&P 500, you can see the S&P 500 went up 24%. And already this year, the S&P 500 yesterday made new highs. We're up another 3.3% this month alone. Okay, that's on the S&P 500. The Dow Jones, which is only the top 30 companies, are up 13%. The European markets didn't do so well. Okay, you can see roughly about 2.2% there for the UK market. China, as I said, they were the biggest disappointment, down 12.9%. You can see right at the bottom there, South Africa, we've barely made into positive territory with 1.7%. Okay, so what I want to highlight for you is just this is the S&P 500. I just want to show you graphically how the markets performed. This is the S&P 500 index. You can see back on the 1st of January 2023, the market was trading at 3,824 points. And at the end of the year, we're sitting at 4,742 points. That's how we get a 24% movement. So a bit of technicals in here. You can see it's all trading above its moving averages. This graph was taken 2 days ago, so even that last bullish side has even gone a bit higher than that. Okay, so yeah, so it's a lot to do. The big story of 2023 was arguably the continued performance rally of what they call the Magnificent Seven. So it's not the Western, some of us might refer to, but the stocks like the Apples, the Microsoft, the Alphabet, Amazon, Nvidia, Tesla, and Meta. Okay, Meta is Facebook. Those ones that drove obviously increasing levels of market concentration. Okay, so saying that, if you look at what's happened on these Magnificent Sevens, you can see there on the chart on the left-hand side, the Magnificent Seven, that's a black line right up top, and in the S&P 500, that's performance. So it's way outperformed the market. But saying that also, Microsoft came out with good results. I think it was yesterday. Microsoft has been here before. So the big question is, how long will this this tech rally last? Will it continue? Will it be continued, be fueled by the artificial intelligence euphoria? But that all remains to be seen. As I say, investors are well served to remember that the good companies, this is also very important to remember, good companies do not necessarily make good investments. Okay, so just remember that, because I say Microsoft has been here before. They saw on this chart on the right hand side, the .com, the black line. You can see the big ramp up in the .com era. The share price went up like crazy, and then we languished sideways for many years. So you can see that blue line, that's what's happening right now with Microsoft. So it's also ramping up, same scenario again. So the point is, overpaying for an asset is a surefire way to put a damper on long-term returns. And when markets are pricing in perfection, like I think they're doing at the moment with these Magnificent Seven, there's plenty of resources of potential disappointment in the future. So just be aware of that kind of thing. Okay, so this is the South African market. South African markets, as I say, we were left for dead by the global markets, especially the US markets. You see, basically in a sideways market, but we barely made any gains on that. Okay, so let's look at the best performance and the worst share performances of 2023. And this is quite interesting. I've only taken the top 10 just to highlight for you. So here's a little table. You can see there's Harmony Gold Mine at number 1. And I'll show you some charts on the top 3 anyway. Harmony, PPC, and Textainer. But you can also see there on the 4th place, there's another gold mining company. So it'd be a surprise for a lot of you that gold stocks would have been the big winners last year. Okay, we'll go one little call it insurance company, financial company in Sanlam, maybe in real estate also in Fortress. But there you got Aspen Pharmaceuticals, Wilson Bailey, Spur, and Raynet. Okay, you can see the average growth there, from 103% right down to 42. If you had these 10 companies in your portfolio last year, your portfolio will grow by on average 60%. Okay, so let's look at these companies individually. So by the way, with Aspen, it might have jumped up 49%, but just in December alone, it jumped up 9%. That was on the whole thing, the announcement that they concluded the agreements to acquire Sandoz, China Pharmaceuticals, for about 1.8 billion. Obviously, it's interesting that they want to expand into China. So that was the big thing there. So we've got interesting things happening with Aspen. Okay, so let's talk about Harmony. As I say, it's a gold mining company. You can see how that's been performing. Beginning of the year, right at the bottom, we moved sideways for a bit, broke out of that sideways market, and then just rallied higher and higher and higher. So you can see at the moment it's making another flat, what we call ascending triangle. So yeah, it could break out of this again. Okay, got a lot to do with the gold price, yes, but also a lot of other little things like um, it's the biggest mining company in South Africa. It's the largest mining company in South Africa. It operates in South Africa and Papua New Guinea. Um, there's I like Harmony a lot. That said, I also like Goldfields. Okay, but yeah, that's 103%, not too shabby for a gold mining stock. If you look at a company like PPC, this was also an interesting story. We were the sweet spots last year. You could have looked at the banks and, believe it or not, the construction sector. So yeah, we're looking at companies like Murray and Roberts. So they started, but PPC, they thrived. They made 83%. And another one was Wilson Bailey. So all the companies that you don't expect to be performing well did perform well last year. So PPC is the biggest cement producer in South Africa. They reported that they slashed their debt big time, from 765 million right down to 381 million. This is end of September. But also they've had a big management change now. Got new management coming on board. So I'm expecting nice things for PPC going forward. And then lastly, you got Textainer. So this is a unusual situation. You can see for a long time we've sideways, and then suddenly we had this big jump. It's a lot to do with takeover talks. Textainer, as the word would imply, they lease shipping containers, and they obviously now looking at delisting from the JSE and New York. There's a company called Stone Peak. They want to buy this company for about 140 billion. Okay, so $7.4 billion. So this company, Stone Peak, specializes in infrastructure and real estates, and the buyout will result in shareholders receiving a cash payout, roughly about $50 per share. And then obviously this whole big thing is that there's a big 46% increase over the last share price, the closing price of October. But the main thing here is that it was an unusual situation. If you did have Textainer at that point in time, it's one of the stocks that I always suggest after a merger talk like this that you take your profits and get out. Okay, yeah. So that's what happened with Textainer. So that's not a it happens all the time. Okay, so what are the 5 things that shareholder, what we call share winners, have in common? So first of all, you ask yourself, is the company profitable? Okay, does the company have solid? Well, a link to profitability, you can also say how much debt does the company have? We just all know with PPC they slashed their debt big time. So you can also say this: has a company got solid sales or revenue growth? Is it positioned for growth and profitability? Does the company have great products that people want? And also, is it a leader in its field? As I say, Harmony is the biggest gold mine in South Africa, PPC, biggest cement producer. So what's also important, are there talented and experienced managers in charge? As you know, with PPC, we've got new managers coming on board that have a lot of experience. There's a Venezuelan CEO taking over now. This guy's got a lot of experience in the cement industry. Okay, and he's a share in high demand. So those are some of the things that you are always going to consider when you're looking at buying a stock. Okay, so I hope that makes sense. So let's look at, whoops, gone too far now. The worst performers, and some of you might have already said Transcap, Transaction Capital, they dropped 75%. If you look at just those 3 companies, again, Transcap, ArcelorMittal, and Pick n Pay, I'll have some graphs on them. But also, just out of that list, you'll see that there's a lot of, we could call it resources. There's 2 platinum companies. You've got Impala and Sibanye. You've got Tongdela, which is the more coal-orientated. So these companies were under a lot of pressure last year with, obviously, the whole Transnet issue. Okay, but you look at Impala Platinum, you look at Bright and Murray and Roberts, they all declined between 57% and 46%. That's a big knock Platinum counters were the route. They got really got shafted last year. As I say, a lot to do with China, demand from China, and obviously it was a big thing. So we'll see what happens this year. So let's look at there's Transcap. You notice one thing I always notice with these graphs: the share moves sideways, gaps down, moves sideways, gaps down, moves sideways, like a stepping stones down. Boing, 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 boing. Okay, so you can use your support and resistance trend lines as a trigger when to get out of your stocks. Okay, but you can see that 75% drop on Transcap. So the big thing here of Transcap is that they lost a lot of money with SA Taxi alone. I think it was 3.7 billion they lost last year. That was an increase from 2.1 the year before. Okay, so yeah, this company, I don't know, it's going through operational restructuring at the moment. But again, you can see it's the candles are very narrow. So there's a lot of buy and hold, call it that. The wider the candles, the greater the volatility. So obviously, the candles move sideways. There's the chart pattern is sideways for a bit. You can see it has bounced off from its lows there, but it's a wait and see. This to me is a real speculative stock. If you want to go trade around with that, we'll see what happens. I'd rather wait and see and look at the financials. Then we talk about ArcelorMittal, which is, if those of you that remember many years ago, was ISCO. Again, very similar chart, sideways, breaks through support, sideways, breaks through support, and that's gone way below its moving averages. That purple line there is the 200-day moving average. So 65% drop. So yeah, the steel market experienced a real demand weakness last year. The key consumer sectors remained weak with low to no growth. So it was very tough for these guys last year. So, again, a lot of things out of the company's control, high transport costs, logistic failures, especially with Transnet, talk about high energy prices, all these things contributed to them. So yeah, they rely heavily on Transnet, rail, for rail transport. But sure, yeah, they really under the cosh here. Okay. Recently they were talking about retrenchments, but they're going back on their retrenchments now. So it looks like there's government talks and things like that to turn it around. So yeah. But again, a lot of uncertainty around a company like this. And then Pick n Pay, again, similar chart, sideways, 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 that drops. Pick n Pay, a lot of people's favorites, but yeah, they reported a loss. They skipped their dividends. The group experienced a very challenging year last year, a lot to do with weak consumer spending or environment rather, load shedding costs, heightened competitive intensity, especially from ShopRite, even Checkers, from Woolies. The CEO, Peter Boone, he resigned. It was effective the end of September. And then Sean Summers, he is a Pick n Pay veteran, ran the group way more than 11 years ago. He's replaced Peter again. Changes in operations, we see what happens here. So this is something you might have on your watch list. Okay, so when to sell or when to hold? These are good questions to ask yourself again. Here's 9 different strategies. Adjusting a portfolio. So some of your stocks in your portfolio might have run, so now you need to rebalance. So that's one reason for selling some of the stocks off. You want to free up capital. You might be in a situation where hopefully you don't have this, but you don't have emergency fund, and now suddenly you have to sell your stocks because you've got a medical emergency. Okay, so that's another reason why people would free up. Change in fundamentals, that is a good reason. The company's loss making, the company's increased its debts, there's no growth potential, all those kind of things we've spoken about before. Those are the other reasons. I always say to myself, the company has changed its original decision. My original decision for buying a stock has changed. Buying to MTN because they were expanding into Africa and all that kind of stuff. Now they become mature, they're not expanding so much anymore. Whatever the case might be, I might start looking at changing my shares there. Linked to that very closely would be the technical signals. If the 50-day crosses below my 200-day moving average, going into a bear market, you might want to use that as a reason for selling some stocks. But my philosophy always is I'm a buy and hold investor. As long as I've done my proper research on good quality companies, I'll still hold it. I use technicals mainly to get into the stock, not so much for getting out. Opportunity cost, your stock might have made some losses last year. One way of looking at it is that's tied to number 7, is that you'll sell these stocks. What you made a capital loss here might offset the capital gains or somewhere else. That's the only reason why I would look at selling those shares. Okay. Opportunity cost, the share's languishing. You don't see any prospect of it growing. You might want to switch into another company. That's what I mean by that. Change of ownership or a merger, like we saw now with Textainer, I would suggest that's one reason to take profits now. Yes, there might be tax implications, but that's one reason for selling. Okay, I will not hold shares in unlisted companies. Too much hassles. I've seen it too many times with corporate actions. Okay, rather take my cash and do something else with it. Tax treatment, as I mentioned, offsetting capital losses against capital gains. But again, I'm not a tax consultant. Please refer to your tax advisor for that. And then, again, if you're an investor, you might want to say, okay, I bought a share at 10 Rand, I've got a million Rand in the stock now, I've doubled, I've got 2 million. Yeah, you might have say, my original decision was to double my money. Yeah, that might be one of the reasons for selling it. But again, I use that more as for trading, more of a trading strategy. And then lastly, a market sell-off. Every time the market pulls back a bit, you panic and get out. That's not the right reason for selling. So maybe you rather move into unit trusts or ETFs if the market spooks you like that. But those are some of the reasons that you might want to consider selling. Okay, so let's look at unit trust quickly. What was interesting here is that if you go down that list, Global AI Opportunity Fund, Global Equity, World Equity, Global Equity. So they're all equity funds. The top 10 funds were all global equity funds. Okay. You can see how also we compare it on the 1 year. So you can see how they performed, 32% right down to 23%. What as you see, number 7 was PhD Wealth Global Creative Feeder Fund, one of our most popular funds. But you can see the point I'm trying to make is a lot of investors went offshore last year. Yes, the Rand did devalue by around about 8%. So guys wanted to diversify geographically. A lot to do with obviously uncertainty around elections. A lot of people are unhappy with corruption and all that kind of stuff, but there's corruption anywhere in the world. Okay, so that was quite interesting. And then obviously, I've taken this from our what do we call A to Z funds, our mega fund fact sheet. So I looked at the bottom lot, the bottom 10. So we got 398 shares in our portfolio, and this is the bottom 10. Fairtree Equity, General Equity Fund, that's from SRC, that's Sanlam. You can see most of these stocks here would be commodity stocks. That was quite interesting. So we went from a -7 loss to Momentum Resources right at the bottom there, 23% loss. Okay, so that was for the year. So it's important to have maybe a portfolio of unit trusts and have it diversified into different sectors and different funds. Okay, so that was also quite interesting. So the winners and losers of unit trusts. Okay, sorry, I've got a frog in my throat here again. Drink water. So the economic outlook. Now this is also important going forward. The question to ask yourself, are your current financial market expectations this year different from that last year? What do you expect to be different? Do you expect things to be more positive, or more negative? So yeah, it's gonna. Last year was a challenging year for investors. As I say, we had a resilient U.S. economy and a slowing recovery in the Chinese economy, as well as obviously decade high interest rates and obviously all the geopolitical upheavals. That hasn't really much changed. I think the big change this year is going to be interest rate cuts, which will improve investor sentiment and also obviously the outlook for growth. So although we should expect another volatile year, we do expect that loose monetary policy will support markets. So it's like a seesaw. Interest rates come down, markets go up. So yeah, we see the S&P 500 are making new highs. We anticipate some profit taking soon, but our market also, is moving sideways. I expect much more out of South African markets. So elections will be a focus this year. Um, Obviously, they will result in well, they usually result in policy uncertainty, which in turn obviously creates unstable market conditions. So very much the same story. As I say, it's more uncertainty and volatility. So right in the beginning, I mentioned all those institutions. They don't even know what's going to happen this year. So there's that wide range of predictions. So it's not easy. US elections, it's a tale of two weak leaders. We've got Biden and we've got Donald Trump. South Africa, we've got the ANC, or we're going to have coalition governments. This national health thing is not going to go away. But I like pharma. Maybe that's why Aspen is diversifying offshore. But pharma and hospital stocks like Mediclinic and Netcare, I'll be very careful of them going forward. The wars in the Middle East, obviously is supporting a oil price. It's hovering around about the $80. Sasol might benefit from that. I love Sasol. It's trading at lows. It's a very, very cheap stock on a PE multiple around about 3. It's got a dividend yield of about 9. It's a good quality company, obviously just been hammered. I think the fundamentals will come back and that company will recover. AI, artificial intelligence, will become more prominent. I think companies like Apple will likely join the party. Microsoft at this point in time, I believe, is doing very well. Obviously, you've got companies like NVIDIA and Intel and AMD in the States. These are the chip makers are flying. But companies like Microsoft and Apple, these are the ones I think will really come to the party too. Inflation will keep cooling, and obviously interest rates may remain higher for longer. We see what happens with interest rate, with inflation in the States. We anticipate by March they start cutting interest rates there, and in our next MPC meeting in May onwards, we start seeing interest rates hopefully coming down here in South Africa. Chinese troubles, obviously we'll still keep a lid on commodity prices there. They've got big problems in China. What we see in mainstream media is not really true. We saw now with Evergrande, that property company filing for bankruptcy. The whole banking sector's got a lot of bad debt on their markets. So local producers will suffer, but I still believe there's a glimmer of hope for our commodity stocks. I think they've been hammered big time, but there might be a recovery next year. Going forward, as I say, Trump will say stuff, and it will land him in trouble this year. El Nino, the weather thing is still impacting food prices. 110 million people will require food assistance this year. So I like companies like the food manufacturers like Tiger Brands, like AVI and Oceana. AVI came out last week, good results. I like AVI, so you might want to be positioned there. I always say it's food manufacturers are a bit of a defensive sector. Be a bit more defensive. Also talking about food, chicken will make a comeback. We've seen this big thing now with obviously the whole bird flu scenario. Companies like Rainbow Chickens and Astral, I believe, will recover. So there's opportunities there too. Again, talking about AI, computer chip sales will continue increasing. I mentioned all those NVIDIAs, part of the Magnificent 7, NVIDIA, Intel, AMD is another one, advanced micro devices. Solar power, the needs will double and Eskom will not improve. Load shedding will be for quite a while. Taxes will remain high. I don't anticipate that ever coming down. And then our potholes, obviously our rainy season and our potholes will increase. I just wish there was a company listed on the market years ago. There used to be a company called Tiger Wheels and Tire. We'll be doing very well on the market. Electrical vehicles will outperform in the first world markets. I don't know. I see all these cars exploding all the time, so I think I still got a long way to go. And then, our local market will remain flat. I still think it's a stock picker's market. If you find the right stocks that are undervalued, are profitable, with manageable debt, I think that's where the opportunities be lying this year. So, let's talk about the economic outlook for South Africa. Weak GDP growth outlook. The real GDP will accelerate to 0.9% this year, 1.3% in 2025. Obviously, last year we're coming off a base of 0.5%. So things are tough. Okay. So obviously, a lot of things that are impacting our economy. Number one, obviously, Eskom, electricity constraints, logistics, and obviously our job sector. So those are things we all know about. So the outlook going forward, we're talking about 1% this year, which is a bit better than last year. Okay. So what things to look forward to? We could see the interest rate cycle coming back, lower inflation, and obviously improvements in infrastructure. And you want to position yourself for that. So talking about inflation, the government or the Reserve Bank has a target between 3 and 6%. Our annual inflation is until November slowed to 5.5%, and expected to even come down to 5% this year. So yeah, things are looking better on the inflation front. Interest rates, between November 2021 and May 2023, Reserve Bank increased by 475 basis points, and there's general consensus that last year May was the end of the hike. So we anticipate that yes, the repo is at 8.25 from here, or 11.75 on prime. We anticipate it start coming down. We anticipate more the second quarter or third quarter rather. Excuse me. Interest rates are coming down. And the market always anticipates this going forward. Excuse me. Okay. Talking about shares in that, we do put out research every week. This is our recommendation. Excuse me. Last year we put out 18 recommendations. We had a 50-50 win ratio. So yeah, they didn't perform well in the short term, but our recommendations are a bit more longer term, 3 years plus. You can see out of the 18, 9 went up and 9 went down. And you can also see the intrinsic value there. So there's still opportunities within those stocks. Okay. So I'm going to grab water here. Okay. And then just quickly summarizing. Sorry, clear my throat. Let me just put this on mute. Got rid of Kermit the Frog. Okay. So, if we had a quick summarize what's happening in the markets, we prepare for significant elections this year. Do you know that there's, I think, 60 countries worldwide having elections this year? So, yeah, a lot of uncertainty around the elections. So, yeah, interesting times. Before I go into that, I think what's also important is just to, you need to prepare yourself for this volatility. And I just want to highlight quickly 9 strategies that you can use to navigate in a turbulent market. So, as I said there on my previous slide, the main thing, as I summarize, is that the uncertainty in the markets will create that volatility. So you need to have some strategies in place to navigate that volatility. So very basic. We've discussed this many times in previous webinars. Educate yourself about markets. Educate yourself about the factors that move markets. To find your investment goals and risk tolerance. Have a diversified portfolio. Have a long-term view on the markets. Have a solid investment plan. Okay. Talk to your financial advisor. I think that's very, very important to have these things in place. And then also there, number 8 is have emergency fund. I think amazing how many people don't have emergency fund when things happen. What's the first thing they do? They sell off the investments. That's the last thing you want to be doing. Okay. So guys, sorry, I'm really getting snotty now. We just move on to the next slide. So in summary, market volatility. I hope you come through. You got that idea. Market volatility is a reality. It comes from uncertainty. Deal with it. I mean, the main thing I always say is just focus on the factors within your control. Yeah, controlling the controllable. I mean, that's a nice little mantra to have. So as I saw with the big institutions, it's difficult to forecast the future. but we can anticipate the interest rate cuts will improve investor sentiment. I think there's opportunities around there. If you had a look at with regarding interest rates, going back to that, I think that would be the big trigger this year. Um, who would benefit from it would be companies that be more exposed to consumer discretionary sectors, information technology companies, real estate sector should benefit from low interest rates, consumable staples, the food I was talking about just now, and even the materials, the resource sector may see a boost when interest rates come down. Okay. Also, what's important, I think, with interest rates coming down, we might think the first thing you want to think about is the banking sector. So in general, savers and lenders will tend to lose out, while borrowers and investors will benefit from low interest rates. If that makes sense to you. So lower interest rates for consumers mean more spending, so you can participate more with the retailers. I would look at first the food retailers, and then we go to clothing and things like that. But lower interest rates for business also means increased production for goods and the creation of new jobs for people who produce, sell, and deliver those goods. Okay, so there's a lot of things to look forward to with interest rates coming down this year. So what we do know is that staying the course with your investment strategy is still key. Okay, and again, just to refer back to those 9 investment strategies, when you get this presentation, go through that again. I think that'll be very important. Oh, sorry, I'll get it reading. So let me see what questions you guys got. Any questions? Sorry, just mix this out. Amon, yes, it is being recorded. Now, I'll hopefully be sending it out a few days by Friday. Vessel, the bottom 3 charts performing to the all share. Sorry, yeah, I haven't really done a rate of strength or anything like that, but I can tell you that's really underperforming. It's way off it. Will interest rate cuts create more forgiving environment for property developers? Yeah, I think so. Okay, Daniel, pleasure. Let me see what other questions are. You had a question here from Jan. Is it a good time to go offshore when the rand is weak? Hey, Jan, good question. Yeah, ideally you should be going or investing offshore because you want to diversify your investments geographically. In other words, you want to spread your risk in different countries. So that's one of the reasons. But secondly, I think it's more important to you want to invest offshore to take advantage of sectors or shares not available in South Africa. For example, that Magnificent Seven, that might be expensive, but that's the idea. You know, you want to be exposed to the AI, you want to be exposed to call it biotechs and things like that. And then thirdly, I think also, I would look at taking my money offshore when the rand is strong. So buy when the rand pulls back. I call it a cyclical bottom. That's the best time to take your money offshore. But also remember, Jan, to gain offshore exposure, you can also do it through ETFs. So through your local share trading account, you can have exposure through ETFs. They trade like a share. You can have exposure to a basket of stocks like the S&P 500 through the Satrix S&P 500. You have exposure to the NASDAQ through the Satrix NASDAQ, for example. But also you can gain exposure to individual shares like the Apples and the Metas. I know there's a whole list of call it first rand ETNs, exchange traded notes. So that's another way of getting exposure. But also you can get exposure through your unit trust. As I mentioned just now, the PSG Global Equity Feeder Fund. You can also get exposure to the PSG Global Flexible Feeder Fund. Those are ways of getting exposure offshore. So you should be diversified in your portfolio, not only have exposure to South Africa. Okay. Sorry, I don't know how to pronounce your name. Falala. Is investing in PPC a good prospect for future investment returns? Well, as I say, things are turning around there. They've got new management coming on board. Yeah, at this point in time, the market has rallied up a bit. I'll buy on weakness, but I like PPC. So yeah, to answer your question, remember this is not investment advice. Just things I'm seeing here from a technical point of view and from a training education point of view. Okay, so I hope that answers your question. Do you think the SA election outcome will have a significant impact on the market? Because, Papa, again, there's pros and cons. Policy changes, that's the main thing that always happens with elections. So we'll see what kind of policy changes. If the ANC does lose their 50% majority, we're already talking about coalition governments. Doesn't really work before. So we're going all into new territory, uncharted territory. So we'll see. Interesting times, as they say. Okay, anything that doesn't change, anything that's constant is change. So adapting to time. Okay, so guys, I'm sorry I've gone over time again. I hope this made sense for you guys. Nice little recap. But from my side, guys, thank you very much for being on this webinar. Obviously, in this webinar, we spoke mainly about stocks and unit trusts. You want to have exposure to them. There's links to our key information documents. But again, from my side, thanks for being on this webinar. Happy trading until next month. Bye for now.